what I told everyone is that you were going to tell us today about a little bit about how Peter Thiel was able to rack up billions of dollars in his retirement account tax-free. Right?
Sure.
That's dumbing it all the way down, right? That's keeping it simple. You can take your 401k and move it into a self-directed IRA.
Yeah. So an individual retirement account is a tax-deferred savings vehicle, right? It works very similar to a 401k or any other kind of qualified plan. Most people that have IRA funds invest in the market. Typically, they have their IRA with a bank or a brokerage firm. They buy securities, they buy mutual funds and stocks because those are the only options they're really given to invest in. What we do is different. We take custody of alternative investments, which could be private stock, private placements, real estate, and other alternative assets. The client has the ability to direct into those investments because of the way that we are structured. We don't sell any products. We don't tell people what to do with their money. Instead, we take instruction from the client, we facilitate, we execute, and we hold. So the reason why you can't place this type of position with Fidelity or Schwab or Merrill Lynch is that they don't institutionally want to hold this type of asset. It doesn't fit their box. It's not a security that they can charge commission for holding. So because they don't do it, and because everybody is familiar with these big banks and brokerage companies and what they do, you don't necessarily hear about the ability to hold anything outside of the traditional stocks, bonds, and mutual funds. So we are kind of a voice in the industry to say, look, if you want to buy something alternative, it is an option. We can facilitate it. We can hold it. If you wanted to buy into a private placement, it would just be a matter of setting up a self-directed IRA with someone like Strata, shifting over those existing retirement plan funds, and then directing us to process and hold that investment. So it's a very simple process.
So we're going to, I'm going to kind of recap what you said in actual real life examples, right? Okay. So first of all, you have your regular 401k, right? Or you're self-employed and you have your IRA. Now, what is the maximum amount of money you can put in an IRA per year legally by the IRS?
Yeah, it's $6,000 if you're under the age of 50. It's $7,000 if you're over the age of 50. If you are self-employed and do not have rank and file employees, there's a plan called a SEP IRA that allows you to put in more than $6,000 per year. But your standard regular W-2 worker is going to put in $6,000 per year. What I see typically in the way of funding is most of my clients have money in a retirement plan already, and they move some of that money to us. So either that's a rollover from a 401k to the IRA, or to transfer IRA to IRA. We will occasionally have a new client set up an account and just put in a contribution, but that's relatively uncommon because most of what our clients are buying, they're investing, $25,000, $50,000, $75,000. So just to set up and put in $6,000 doesn't really work. Most of our clients are moving over some existing retirement plan assets to invest in somewhat larger investments.
Absolutely. I'm just setting up for you right now. I'm just setting up as to how it starts from the beginning, because my audience is very wide. We have audiences that are your accredited investors, and we have audiences that are small business just getting started. We have the audience that is the W-2 wage earner that may have, and a lot of people have quit their job and they have those 401ks you're talking about. But I wanted to talk about how it's $6,000 that you're putting in, but per year. So let's say you've had your IRA going for the 10 years. You've only been able to put in a max of $60,000 in 10 years, unless you have a company match in your 401k and they match that. So now you have 120. Let's say you've been building that thing, like you were just saying, for the last 20 years. The whole reason why we are here right now is to talk about how you can accelerate that money, because that's too slow. That's ridiculous. Like, who's going to have a retirement where you're only able to put $6,000 a month? And if you invested in stock market, you're probably getting an average of 10% per year, right? So if you look at the rule of 72, that rule of 72 says you can basically double in about 7.2 years. So when you work with a company like Strata Trust Company says most IRAs are just only invested in the stock market. But this is what he just said. They're only invested in the stock market. However, remember, we're all about building wealth here. So the other way you can do it is moving over into an alternative investment.
Yeah, we see private real estate funds like syndicated real estate offerings. Those are fairly common. We see venture capital funds where a client's investing in something that then goes out and seeds individual companies. We see direct investments in startup companies. Yeah.
I'm always pitching real estate because we have the Clearview Eastern Fund. We are buying multifamily properties, 50 units and above. And so because we're a private placement, we actually have a private placement with Strata Trust Company. Whereas if you have a rolled over, you can roll over your 401k that you left at some job over into a self-directed IRA. A company like Strata Trust Company may be able to help you get that done. And then you can invest those funds into real estate. But you also mentioned, this is where the Peter Thiel idea comes in. You also mentioned venture capital. The co-founder of PayPal is Peter Thiel, and he used something called a Roth IRA. He invested into PayPal with the money in his Roth IRA. So could you tell me about that a little bit?
Yeah, the process for a Roth is the same as with a traditional IRA. It's the same core: set up an account, fund the account, direct the investment. Benefit of a Roth IRA is, as you indicated, a Roth IRA is tax-free growth, whereas a traditional IRA is tax-deferred. So with a Roth IRA, to use an analogy, you pay tax on the crop or on the seed, but not on the crop. So as it grows, it is growing tax-deferred. And as you take it out later in life, it's tax-free upon distribution. So the benefit there is you're virtually eliminating what would be normal capital gains on a taxable investment by keeping it tucked inside of that Roth IRA, which has that built-in tax-deferred piece. So you could take a Roth IRA and invest in a deal like what you're offering, your PPM. You could invest in a startup company. You can invest in a venture capital fund. You can invest in a direct piece of real estate, whatever you just choose to invest in. But the gains that would normally be owed upon the sale of that investment would be deferred, or in the case of a Roth IRA, you could think of it as eliminated because the Roth IRA by nature is not taxable. It's a tax-free entity on the growth side. So the benefit there is that you're going to do something with your IRA to grow that over time. The question is, what is that something? Do you want to invest in real estate holdings? Do you want to invest in alternatives? Or do you want to invest in the market? If you want to invest in the market, you can do that through anybody. But if you want to invest in alternatives, you'd need a self-directed IRA, someone like Strata, to hold that position and provide that passive custodianship.
Could you tell me a little bit about the technicality? Why do we have to go? And we spoke about this the last time we spoke. Why do you need a third-party custodian? Why does Fidelity not offer those? And, what is the legality behind needing a third-party custodian at all? Yeah. Why can't I just say, this is my retirement money, and I want to, invest it in whatever? Why do you even need a third party?
Basically, a stipulation the IRS put in place back in 1974 when they created individual retirement accounts. The idea was it was a tax-deferred savings vehicle, but it has to be held by a third-party custodian. So that's an IRS limitation requirement that if you want to have an individual retirement account, you can't just open a bank account and call it an IRA. It has to be parked with a bank or a trust company or somebody else that's eligible to check the box as IRA custodian. So the custodian does the reporting, the 1099s, the 5498s, they do all the record keeping. That's embedded in what any custodian is going to do. The distinction with Strata and self-directed IRA custodians and someone like Fidelity and a more direct traditional custodian is that most custodians on that side will also take on a fiduciary role. They will sell products, they'll push investments. With Strata, we are just basically an order taker. The client tells us what to do. We make sure it's a permissible investment to hold. We execute and hold it. So it's much more of a passive client-directed relationship than it is us selling or pushing a product. So that's the reason why you need a custodian. The reason why firms like Fidelity and other large big bank firms don't want to do this is twofold. One is that it doesn't fit what they do. It's not an easy investment for them to hold. If I call up my broker at Ameriprise and I want to buy a stock, he clicks the mouse, buys the stock, and it's done. It's very easy for them to do that because that's what they're set up to hold. The other side of it is the fiduciary limitations. If it's a private placement, private hedge fund, or real estate acquisition, unless that brokerage firm is really going to dig in and look at what that company is doing with your money, it's a challenge for them to determine if it's in your best interest. And one of the requirements of a fiduciary is if you're going to hold a position for an IRA, they have to make sure it's in the client's best interest as fiduciary. So it's very hard for them to straddle that line to sell publicly traded investments, which they can easily analyze, vet, and approve, versus private placements, which are much more challenging to track, to hold, to analyze, to vet. So they just institutionally, because they're not making money off of it, it's not a click of a mouse. It's much more challenging to determine what's going on within the investment. They just institutionally don't want to fool with it. It doesn't make sense for a firm like Fidelity to try to constantly be updating their system with what's going on at Clearview Eastern Fund. Whereas with us, we understand it's inherently going to be an alternative investment. We understand we're not going to get an updated value every week, month, even quarter. We're just going to get a once a year update on the value, the inner workings of the investment. Not to say we don't care, but we're really not. It's not as important to us to underwrite the investment because we're not selling the investment. We're not pushing the investment. We're not telling clients to self-direct and invest with you, but rather the client is telling us, I've chosen to self-direct. I've chosen to invest with you. We're just executing. So us being a neutral party, being a facilitator and not an advisor, we're not a fiduciary. We don't sell product. We're just a passive paper pusher that takes orders and does investments. That's what opens the door to us to allow for this type of position. And to be quite honest, the industry has become very polarized. Banks and brokerage firms have completely moved out of alternatives. They don't want to hold it. It's a toxic pain in the neck for them to get involved. So they push that off to companies like Strata. Our industry, self-directed IRAs, really focus almost exclusively on these assets and pick up anything you can't do through Merrill Lynch, Charles Schwab, Raymond James, Fidelity, et cetera. So there's a need out there. We're filling the void by servicing that need. And I do think that the ability to do it is certainly something that's become more popular, more well-known, still relatively unknown, unfortunately. Not everybody realizes they can self-direct and hold this type of asset, but certainly better than when I got into the industry 18 years ago when relatively nobody knew anything about alternative assets. So the Peter Thiels of the world and the Mitt Romneys of the world that have done this and had great success have kind of shine a light a little bit on what we do. And that coupled with just the ability to Google it, the influx of companies that have moved into our space, just the access to information, all of that is kind of compounded to where now our industry is a lot more sizable than it was just in recent years, but still relatively uncommon compared to what most people do with their retirement wealth, which is just stocks, bonds, mutual funds, and ETFs.
And people just don't know. It's so amazing. It's so amazing. And I'm shocked right now that you said 10 years. 10 years. It's only been 10 years.
Well, we've been doing this for
more. You've been doing it for years, but only 10 years since 10 years ago when you got in the business, no one even knew.
Yeah, it's definitely upticked significantly. I mean, just look at our space. There was probably 5 to 7 companies doing self-directed IRAs back in 2004 when I started doing this. Today, there's easily 50 companies in our industry and more coming on the scene all the time. Plus, you just see a lot more advisors that are starting to open up their eyes to the potential benefits of alternative investments. Now you'll talk to registered investment advisors. They didn't ever talk about alternatives. Now you hear a lot of people with a lot of buzz about you should have 5, 10, or 15% of your total retirement portfolio in alternatives. It's a diversification play. It's non-correlated, so the market can go up and down, but if you're in real estate, it's not going to flow with the market directly. So it is becoming more popular. It's more common. I anticipate that trend's going to increase and continue. But again, it's a matter of just getting the exposure out there, let people know what their options are. My takeaway from it is not everybody's a good fit for a self-directed IRA, but it doesn't hurt to know what your options are, to know what you can invest in, right, and then make that decision for yourself. And, right, and I do think that recent turmoil in the industry, in the market, 2020 experience, nobody saw that coming. It dropped tremendously, came very quickly back. That kind of volatility always kind of highlights the need for diversification. And people talk about diversifying, but only within the market. And true diversification requires alternatives that are non-correlated outside of the market. If you have a syndicated real estate offering that's cash flowing and making good money and doing good things, it really doesn't have any bearing on what's going on with the market. It's not impacted by the market. So you've got your money in the market, the stocks and mutual funds and bonds, but you're also over here playing in the real estate space. So you're spread out into various holdings, and that provides for a better nest egg, better diversification, and potential better long-term results. One thing I would say is I'm happy to be a resource for anybody that's looking for information. I find that typically people don't dive in with the self-directed IRA without having a conversation to kind of get their head around it, because it is different. Absolutely. If you've been investing for 20 years and never self-directed and bought an alternative through an IRA, it's unique. It's different. It's not challenging, but it is different. And because it's different, we understand that, and certainly have people available, myself included, to explain how it works. We're never going to tell anybody what to do or how to do it. But if they tell us, hey, I'm thinking about this, my money's in an old 401k, I want to roll it over, how do you actually make that happen? That's a lot of what I do, is just kind of guide people through the system, guide people through the process. So happy to be a resource, happy to be somebody that can answer questions and help folks out as they need. And, everyone's situation is just slightly different. I mean, what I do is fundamentally the same in most cases, but everyone's situation is a little bit different. The investment they're going into, where the money's coming from, the mechanics of getting it done. So, we have high level professionals that are pretty seasoned at what we do, myself included. We're available by phone, email, or text. I'm happy to answer any question just to make people feel comfortable, even if they're not going to move forward. At least they have the information so they can then decide, does it work for this deal? Does it work for a future deal? What's this all about? Because we understand that this is new to a lot of individuals, and they're not going to move unless they feel comfortable with it. So a lot of what we do is educate and just be a resource.
So the maximum, even on a if you're self-employed and you have a SEP. Yeah. If you have a SEP, and then I'm going to finish with one complicated question. Okay. I was talking to Tom Wheelwright. No, I was on a Zoom with Tom Wheelwright, Robert Kiyosaki, CPA. Yeah. That it didn't make any difference that you were in a self-directed IRA if you were investing in real estate. Do you get what I'm saying? Like, you can invest outside of a self-directed IRA and still get major tax benefits. So to put it inside of a self-directed IRA, that's going to be tax deferred. It's like a double taxation goodie, but it's of no use. What's your opinion?
It totally depends on what the client's investing in. I will say this: most of my clients invest in real estate personally. They invest in real estate through their IRA. So it's not always an either or. It could be a per deal situation. And so when you look at depreciation within real estate, that does offset potential taxes that would be owed. But inside of the IRA, there are no taxes that are owed. The gain, the rental income, the return on investment is all built in tax deferred. Inside of a Roth IRA, it's built in tax free. So I think with the Roth IRA, that washes out all questions of how best to structure, because tax free growth is pretty much the way to go if you can get into a Roth IRA. I don't think anyone would argue that. The question is, on a traditional IRA, if you're looking at one individual investment and it's pre-tax in that traditional IRA, is it better to own it outside of the IRA, write off depreciation, interest, expenses, and improvements? Or is it better to own it inside of the IRA and not pay any taxes on the rental income or the gain? I think you just got to run the numbers and see what fits best. I mean, I will say this, that the write-offs offset taxes that would be owed. If there are no taxes that are owed, the write-offs are irrelevant. So again, you're not going to take depreciation on an IRA-owned investment because there's nothing to write off. Writing off zero is zero. So I think it depends on the deal. If you're investing in a private placement, that works more of like a fund. It's not a direct real estate acquisition. So the question is depreciation passing through to the individual investor in that investment? Is it a true K1 pass-through that depreciation might be passed through? Or is it just more of like a dividend or a distribution from a private entity set up like a true PPM structure? So really, I don't think there's a blanket statement. It works best as X. It really depends on the individual situation, what their current tax year situation looks like. Do they need the write-off? Will they get a write-off based on the structure of the investment? And then the other question is, you have to do something with your retirement wealth. It's not always like I'm looking at property A and I'm trying to decide tax-wise, is it better to buy property A personally or through an IRA? Sometimes it's a matter of I'm looking at my retirement plan. I'm 42 years old. I'm not going to retire for another 20 years. I have to do something. And if I feel like that something is going to be better return from a real estate acquisition than investing in the market, then that's just a personal decision I'm going to make for my retirement plan. So I've got a lot of real estate investors that are clients of mine that they don't really care what's going on in the market. They have no desire to invest in the market. They don't understand the market. They understand real estate, right? I've got hedge fund guys that understand hedge funds. I have venture capital guys that understand venture capital. So if you know something, if your area of expertise is better accessed through a self-directed IRA, then it might just be, I mean, the tax question goes out the window. It's just a question of how can you build up that retirement plan wealth? And I'll finish it by saying that in the past, Roth IRAs were relatively uncommon for high net worth individuals because they weren't eligible to get into them. In today's world, anybody can convert pre-tax IRA to a Roth IRA. Now, you pay taxes when you convert it, but after the conversion, it's tax-free for life thereafter. So if you're adamant about eliminating taxes and you're willing to rip the Band-Aid off now and do a conversion, now you're tax-free for life inside of that Roth. So there's no question of, do I need depreciation or do I want deferred capital gains? It's all tax-free inside of the Roth IRA. So building up a Roth IRA, as Peter Thiel did, is a way to grow wealth on a tax-free basis with no taxes involved, assuming you keep the Roth for at least 5 years, assuming you're 59 and a half when you pull the money out, that distribution out of the Roth is going to be tax-free. So everyone's situation is different. Again, talk to your tax advisor, talk to your financial planner, talk to somebody in my space if you want to better understand how to do it. We are not telling everybody to self-direct and everybody buy real estate. What we want everybody to know is if you have a desire to buy alternatives and you do have a retirement plan, you should at least know your options. And those options are out there and are readily available. Again, this isn't the ultra niche business that I started in 2004. There are plenty of companies that do self-directed IRAs. It is out there. It is now being advised by registered investment advisors to get some money into alternatives. So it's something to consider. And, anything we can do in a way of servicing, accessing, being a resource, we're happy to help. Yes, correct. Stratatrust.com. And there's a ton of information. We got a resource center, white labeled articles that people have written internally, externally. A lot of good content there. We pump everything out on LinkedIn and Facebook every day. We got different articles that get produced. So plenty of information.
There's a real estate article that you've got in there that is phenomenal. So I highly suggest anyone go to stratatrust.com and then go into individual and then look under real estate. And there is an amazing bunch of information right there that I thought was invaluable. We actually linked to it on our blog at clearvieweastern.com. I should have just told you to go there first. Just go to clearvieweastern.com and you will find that link straight to that PDF, which is fantastic. Thank you so much for your time, Patrick. You are amazing. We are so happy and blessed to be working with your company. We've already sent some investors over there that are really excited about working with us, and we'll continue to, work together and partner together on helping people build wealth, because that's the key to everything, right?
Good. No, I'm happy. It was a pleasure to do this with you today. If I can help in any way, I'm just a phone call and email away. Let me know. And I appreciate it. We'll do it again sometime. Thank you.